Welcome to Passive Investors Playbook. I'm your host, Charlie Hardage. In each episode, we'll sit down with successful people that turn to real estate to build and grow their wealth. We do a deep dive into why they chose real estate and what makes it so attractive to them. We explore why people in their industry could also benefit from passively investing in real estate. Whether you're a beginner or an experienced investor, a doctor or a professional athlete, love your job or hate your job, our show is here to help you build a profitable real estate portfolio while maximizing your free time and minimizing stress. So sit back, relax, and get ready to learn from some of the best in the business. Welcome to Passive Investors Playbook. Thank you for listening to Passive Investors Playbook. My name is Charlie Hardage. My guest today is Randy Smith. Randy is the founder of Impact Equity, which was formed to help investors achieve strong results in their passive real estate investing strategies. Randy and Impact Equity have helped more than 90 investors place over $6 million across 3 operators in 12 different opportunities since launching in June of 2022. Randy started his real estate investing career doing out-of-state, single-family, long-term rentals, and he quickly realized the many additional benefits he could receive by switching his strategy to passively investing in multifamily syndications. Randy has now invested in 24 different passive investments with 10 different operators, which gives him the unique knowledge and expertise to recognize a strong passive opportunity. Randy currently resides in the Phoenix, Arizona area with his wife, Jenny, and he spent 25 years working in various business development and leadership roles in corporate America. Man, Randy, thank you so much for being here. I'm really excited to talk to you today.
Yeah, absolutely, Charlie. Thanks so much for having me on the show.
Yeah, man. Okay, so we were talking a little bit before we started recording, and then reading it on the bio right there, and I love what you're doing, and I'm going to call it a new model. It's not new, but it's newer to me, and I know. I think I've had one other guest that does the fund to fund model. So before we get into that, I want to hear your story and your background. You're in corporate America. How did you get into real estate?
Yeah, good question. So I was a corporate America sales guy, 25 years, as you mentioned in the bio there. I spent the majority of my career in 2 different organizations, kind of pre-layoff one and post-layoff one, we'll call it. So pre-layoff number 1, I was the standard sales guy, spending all my money, not really saving, not paying off the debt, just, waiting for the next commission check to come to go blow it on silly stuff, right? So I ended up getting laid off from that job after almost 10 years, almost 11 years. And fortunately, I did get a severance package, but every single day that went by that severance clock was ticking, it got scarier and scarier because I was going to have to go out and find another job. And it was a hard time to find a job back in 2011 because of all of the things that were going on then. So fortunately, as luck would have it, I landed at another great organization where I would spend, another 10 years or so. But about halfway through my tenure in that second organization, the memory of that first layoff came back and started to haunt me and really inspired me to take a look at what I can do to help decrease my dependence on that W-2 income. Now, I was very, very fortunate and I made very good money in that role. So it was, as Dave Ramsey would say, I had a big shovel essentially to pay off all the debt. But it really put us in a situation where we started to accumulate some capital. And I knew I needed to put it somewhere other than the stock market because I had seen far too many people get crushed with the stock market in previous years, family members included. So I started doing what probably a lot of your listeners do, and I started listening to podcasts and reading books. And, I was fortunate in that role where I had the ability where I got to interview highly successful entrepreneurs. And I found this common theme that the folks that had done really, really well had either made money in real estate or they held capital in real estate. And that was what initially prompted me to start investing in real estate back in, I don't know, 2018, I believe it was. So not that long ago, real honestly. So I started buying single family out of state because it just didn't make any sense to do here in Phoenix.
Why was it too expensive or not enough homes, or why not in Phoenix? Because I know now Phoenix is the sexy market.
Yeah, well, I mean, Phoenix is always sexy for real estate, no doubt. But I didn't want to buy assets that were going to cost me money to hold. I was really looking, not necessarily to have heavy cash flow on the front end, but I certainly didn't want to have to come out of pocket. And if you were doing long-term hold in Phoenix, you would certainly come out of pocket unless you were putting very, very large amounts of money down. So from Phoenix has historically been known as an appreciation market, and it tends to hit the highs very high and it hits the lows very low. So I looked in other markets where you could actually cash flow on single family long-term rentals.
Okay, very cool. So Phoenix has always been the sexy market, but looking more for cash flow. I love that. Um, and so you were in sales. I just kind of want to recap that. About 25 years spent, sounds like about half of that at two different organizations, or most of that at two organizations.
Yep.
After about 11 years, you lost your job. You got a severance package, picked up another good job, and about halfway through that tenure, 5, 6 years, you got you were haunted a little bit.
Yeah.
I chuckle there. I shouldn't. I'm sorry, but haunted in a good way, because you took a step back and you're like, okay, we got to do something. I don't want to rely on W-2 income. Don't want to have those golden handcuffs forever and ever.
Yep. Yep.
And so you knew family that was crushed during the stock market. I do too. I think most of us do.
Yeah.
And it can be extremely volatile. So 2018, you started investing in single family homes in different markets other than Phoenix. Um, when did you move over to, and you were doing that passively, correct?
Um, the initial goal was to be doing that passively, but it was anything but
Yeah.
in my experience. I think the only time you're going to have true passive income in a long-term rental is if you buy new development, single family. And even still, I think over any amount of time, it's not going to be as passive as many folks want it to be.
Yeah. We had a home, we had lived in it. It was brand new when we bought it. I think we only lived there a year and a half. Thank God we had phenomenal tenants that moved in there, but I still had to fix stuff. I'm like, this home's barely 3 years old. We had to put a new
Yeah.
microwave in there. I think it was the freezer and the dryer, some appliances and a couple other minor issues. But that's a very big misconception, I think, even among real estate investors, of they're in real estate for passive money, passive income. So they go the single family route, but it's not as passive as 90, probably 8% of single family owners think or want it to be.
Yeah,
So
no doubt.
what got you into the syndication space then?
Yeah, so I think we had accumulated, I think it was 6 single families, 2 in one market, and then 4 in another. Um, and we made a lot of mistakes. We did the Burr strategy in the
Okay.
second market, and we over renovated. We were in probably D class neighborhoods, and we turned them into B plus, A minus assets, which we had no business doing that. We bought some turnkey rentals in Kansas City that were definitely not turnkey, anything but. Honestly, it was a total nightmare, total money hole, money pit for both of those assets. So, we were gradually creating wealth by doing primarily the Burr strategy more so than the others. But it was very labor intensive, and it was pulling me from my job. I was having at least weekly calls with the property manager, at least weekly calls with the contractors, and it was pulling me away from this high earning W-2 job, which it just didn't make a lot of sense to do that. Um, That combined with the fact that the market was just exploding, so it was getting harder and harder to find assets where the numbers would work or pencil, because I was rather conservative on the front end when going through the acquisition process. So, all of those things kind of pointed to, if I truly wanted to decrease my dependence on my W-2, I was going to need to accumulate probably 50. The goal was 50 paid off or 100 financed homes. And after doing just 6 of those, the thought of doing 50 or 100 was just, it was unmanageable, and certainly imaginable as well. So I started looking at getting more doors under one roof, like a lot of people do.
Yeah.
Um, and, I started looking initially at 10, 15, 20 unit apartment complexes that I could personally take down. But it just scared me. When you make a mistake on $100,000 single family home, maybe it'll cost you 25 grand if you screw things up. But if you go buy a million and a half, $2 million asset, that's a very different type of situation. So I didn't have the skill or the expertise or really even the desire, quite frankly, to jump into those type of bigger assets on my own. I didn't have the experience to jump into those.
It's a big jump. It's a
Yeah,
massive
yeah,
jump. And like you said, Randy, the $100,000 property or even $1 million property, still massively different than 20 units that are still $1 million, right? Which
yeah,
can't really find good properties for $50,000 a door. But anyway,
no,
I digress.
yeah.
Um, so yeah, it is a massive jump. But now your strategy, which I want to talk about a ton, the fund of funds, you're still passively investing, but you're doing it at scale. So first off, I don't know, like I said, it's somewhat newer for me, but do you want to talk maybe about what a fund is and different types of funds versus a fund of fund?
Yeah, so we can, I mean, very, very high level in this space, you will find, and where I initially started investing was just going directly to a syndicator, and it could be a single asset investment or it could be a multi-asset investment. Um, but I started on that path and I shifted all of our capital over the course of a couple of years from all of these single families and other holdings into those type of deals. So going directly to the investor, much like yourself as a syndicator, and basically choosing the jockey to bet on, putting my trust in them, knowing that they'll be good stewards of my dollars, and sit back and have a true passive investment opportunity. And I think I had done that. I'd done that probably 12 or 15 times by the time I got laid off the second time. And fortunately, at that point, though, I'd invested enough in the space and created enough wealth with the single families that I didn't have to go back and chase another job at that point. So it was really the power of investing in real estate started to really manifest itself in our lives because we had all kinds of options now compared to when I got laid off 11 years prior, right? So at that point, I started digging into the space more because I knew I wanted to go full time in real estate at that point. And I had referred, being a sales guy, I was telling anybody and everybody that would listen what I was doing as a passive investor. I thought it was the greatest thing in the world. You can double your money in 3 to 5 years and you don't have to do anything other than find a good operator in a deal. And my excitement kind of bled over to my friends and family. And I ended up referring about $1 million worth of capital to one operator here in Phoenix. And so I get laid off and I call him and I'm like, I'm not sure what I'm going to do, but I'm definitely going into real estate full time. And he's like, well, Randy, you've been bringing capital to me for a couple of years now. Why don't you just form a business that does that professionally and then share it publicly or at least with your network? And let's see if you have some success with it. And sure enough, I partnered with him on the next deal. We brought 830 grand to a deal and we all got better returns because we were bringing a bigger check. And it just like the light came on that my superpower with 25 years of sales with my passion and excitement around real estate investing and syndication as well, marry those two together, and I can help a lot of people overcome the same challenges that I had overcome and help them decrease their dependence on the W-2. So from there, it's just been, I mean, it's been a heck of a ride over the last 18 months, but we've helped a lot of people get into this space and start their journey as a passive investor.
I love that story. So going back, you only about 5 or 6 years ago said to your wife, okay, we got to figure something out because we need to stop relying on W-2 income. That was only a few years ago. That wasn't
Yep.
20 years ago, right? So that
Right.
was only 5, 6, maybe 7 years ago that you decided that. About 5.5 years ago, you got into real estate, and that's real estate. That's not syndications. That's just real estate.
Yep.
And then about when did you get into syndications? Do you remember?
So it was 2020,
20? Okay.
2020, I believe.
So we're recording this day after Christmas in 2023. So
Yep.
within 3 years, um, in 5 years of investing and 3 years of going into syndications, this is your full-time job. What's great about the fund-to-fund route as well is, and Randy, you touched on one of the points is because you're coming in with a big check, right? You're not coming in with
Yep.
50,000 or 75,000. You're coming in with a big check. So it makes it easier for the operators that you work with. So in return, they give you a little bump in the overall returns, which
Yep.
that little bump, you know, it depends on each deal, but it actually amounts to a lot of money overall.
Mhm.
But then the other thing that's great about what the fund to fund route and what you do, Randy, is you are a professional fund to fund manager, right? And so most passive investors, and I know when I started investing passively, I didn't know what questions to ask. I was
Yeah.
like, heck, I can make a lot of money. This is great. It was a little more in detail, in depth, but not much, right? But
Yep.
you, because you've done 24 of these, you've raised over $6 million. You know what questions to ask. You work with, I think it was 3 operators exclusively, if I remember correctly. So you know what they look for. They know exactly how to work with you best, and you know how to work with them
Yep.
best. And so not only are the returns better for your investors, but your investors should know, hey, Randy and whoever you work with, they're on first name basis and they talk all the time. It's not like you guys met one time and you threw 6 million
Right.
out, right?
Yeah, no
So
doubt.
there's this trust factor that they have with you, but then there's this massive trust that you have with those 3 operators because you're not spreading your money around 45 different people, right? which
Exactly.
is
Yeah.
which is good for your investors. It's great for your investors. So man, I love that fund to fund route and that model because there's a lot of benefits for not only you, but your investors and for the operators that you work with.
Yeah. And I think another important thing that that wasn't mentioned is that just like any investment, it's important to have diversification. And
Mhm.
more often than not, what I find is folks that are newer getting into the space, they'll find an operator that they like. And more often than not, if it's, well, the type of operators that I work with will generally work in one type of asset class. They will have a very narrow scope as to what they focus on, usually in one or two, maybe three markets max. But it's very specific. It's very cookie cutter. They do the same thing over and over and over and over again. And I think that's a good thing. The challenge, though, is that if you only know that operator, there's no diversification. And one of the main benefits that I bring to my investors is, yes, due diligence that is probably much higher caliber than what an individual is able to do. But more important than that is I can actually give diversification across asset classes, business models, geographies, and deals. So by working with a organization like mine, or investors might see 10 or 15 deals a year that are scattered across all of those different types of variables. So I think it's really important as a passive investor to spread your dollars across multiple deals in asset classes. Um, we see markets shift, and if you've got all your money in one spot or one place or geography or business plan, it can be a pretty scary place to be. So
Yeah, when things are good, it's okay, but they're
yeah,
not always great, right?
yeah,
And I'm a big proponent of diversification, but diversification within real estate because stock market, you can't control it.
yeah,
Bitcoin and all that, I don't even know what that is. Um, but
yeah,
with real estate, you do have that control factor where in the economies of scale. And like you said, Randy, different markets are good, different asset classes. So whether it's a mobile home park or retail or industrial, multifamily, whatever that is,
yeah.
um, you know, great to diversify because there's always going to be some things that are doing great, some that aren't
Mhm.
doing as good. And so you don't want all your eggs in the not good basket at the same time.
Yeah.
But man, I want to, so speaking of diversification, before we started recording, we're talking about some of the upcoming deals that you have. Um, can you talk about that? Are they 506C?
Yep. Yeah.
Yeah.
So, and good question too. And something that's kind of unique in the fund to fund world is um, there's not a lot of non-accredited opportunities available in the fund to fund market. You generally need to be investing directly with syndicators or with folks like me that work in a co-GP situation. So, fortunately, though, I have a couple of opportunities right now that are 506Cs. So they're only available to accredited investors. And one is a 335 unit, 1986 built apartment complex in San Antonio. And I'm doing this one in partnership with a group called Lone Star Capital, which is based out of New York, and they buy primarily in Houston and Dallas and San Antonio now. And I think they've done 19 acquisitions since starting, I think 2018 as well, with a couple of full cycle deals. But it's your standard, probably B minus value add opportunity. But what's unique about this one is that they were able to get a very significant discount on this asset because they've bought previously from this seller, and they're combining it with a tax abatement strategy, which literally cuts their tax bill in half by simply having a portion of their units for affordable housing. So the value add play here is getting the approval on the tax abatement program and then doing your standard turns and just doing what they do well, which is take care of their assets and over time renovate the units, but not one of these, 18-month full court press to renovate 300 units,
Yeah.
$25,000 a unit. So great opportunity. It's going to have like over 2x equity multiple. The cash on cash year one is 5.7%, jumps up to almost 9% in year two or three. Just a really great multifamily investment opportunity.
Okay, so several points on that. Number one, San Antonio is a phenomenal market. We have a property in Universal City, which is just, I think it's touching San Antonio, but it's right there
Okay.
by the Air Force Base, by Randolph, and it's doing great. That is one of the fastest growing markets in Texas, even though everyone's already heard that name before. San
Yeah.
Antonio, it's not like some podunk town in the middle of nowhere. San Antonio has so much room for growth, and I'm kind of surprised it's taken this long. When I was 3 and 4, I lived in Alamo Heights, which is North San
Okay.
Antonio.
Yeah.
Haven't been back in a long time, but San Antonio is a phenomenal market. And so the other thing about the tax abatement is that part of the program that Texas has, where there's only like 10 properties a year that get that distinction.
Yeah. So there's a number of different strategies with tax abatement that
Okay.
can be leveraged. There was a program that Lone Star used last year, actually a number of folks used last year called PFC. Um, the PFC program, I think it was a 100% tax abatement program, but it required 50% of the units be affordable housing. Um, but they twilighted that program in the fall of last year. It had been talked
Okay.
about being twilighted for a number of years because the affordable housing rent rates are actually higher than the in-place rents. So it wasn't really bringing any value.
Okay.
And yet it was offering these huge tax offsets. So we did a project last year with Lone Star, not last year, it was this year. I'm already ahead in 2024. Um, but there was another program called HFC, Tax Abatement Program, which is very similar to PFC, just some slight differences. But this new strategy that they're leveraging is, and I'm still working through understanding all the details that there are, but it's a different program than HFC. It's in partnership with you have to have a nonprofit organization involved with it as well. But it opens up a window for tax abatement once again. So it's if you're dealing with or wanting to go after the tax abatement strategy, it's important to work with operators that are very well versed with it and very well
Yeah.
connected politically, because it's not as easy as filling out a form and getting it approved. It can take months and months to get these things approved. So um, being sure to work with the right operator is really, really important.
Yeah. It's government after all, right? So
Yeah, yeah, exactly.
the amount of paperwork there is intense, but it's like you said, it's not just paperwork, it's connections and
Yeah,
relationships. So
yeah.
man, that sounds like an awesome deal. You also mentioned cash on cash, and can you maybe explain what cash on cash is to someone that has never heard that term?
Yeah, yeah. And I think this is something that I didn't totally understand when I first started passive investing. I saw average annual returns and I thought, see a 20% average annual return. I thought I was getting 20% on my 100 grand year one.
Yeah.
And that very much is not the case. More often than not, in these value add syndication models, most of the capital that or most of the cash flow that's coming back is generally being reinvested into the assets. So cash on cash year one is generally going to be much smaller than what you might see in year two, three, four, or five down the road. So, the simple calculation is how much monthly or quarterly returns will your distributions be based on cash return in year one is the important metric. So if you have a 5% cash on cash year one on a $100,000 investment, that means you're going to get a total of $5,000 back in year one. So 100,000 times 5%, $5,000. So if it's monthly distributions, that's something like 440 some odd dollars per month. If it's quarterly, it's $1,250 per quarter. But really important to understand what that metric is.
Yeah, and just so the audience knows, that's a pretty good number in any market, but especially right now. 5.7 is what you said.
5.7 year one. Yes,
Yeah, year one. Because most the ones I've seen recently have been twos and threes year one,
exactly.
and a lot of times it's not even that.
Yep.
So 5.7 year one is phenomenal. Um, I love San Antonio. Sounds like a great deal. That tax abatement strategy that you talked about sounds like I'm talking about the old model. But and it's interesting too, because we're talking about how to not pay taxes, right? But the government allows this stuff because they don't build the housing themselves. And so they incentivize people like you, me, Lone Star Capital, and these people, these investors. If you build or if you create affordable housing, turn them
Yep.
into affordable housing, we're going to reduce your tax burden, the property tax. And what that does too, when the property tax gets reduced, the NOI goes up, the net operating income goes up, which means the value of the property goes up.
Yep.
So just wanted to put that into perspective because the government is allowing this. They're not doing anything shady here. They're allowing
Mhm.
that, and in fact, they incentivize it.
Yep.
So when you work with people like Randy, who is extremely well connected and does his due diligence, then you can also benefit from those property tax reduction and just the overall business plan. And I think you said 19 deals that they have.
19 deals so
Yeah,
far. Yeah.
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 So they know what they're doing for sure. And then you also, going back to the diversification a little bit, I want to talk to you about your other fund, the short-term rental. Is that right?
Yeah.
Short-term rental?
Yep. Yeah. No, we have, I work with a group called TechVestor, which they are it was founded by a couple of ex technology folks, like ex Google and ex Apple employees that were very big players in those organizations. And they founded a group called TechVestor, which is a short-term rental fund that has acquired, I want to say, 120 or 130
So,
single family homes across 10 different markets. 50% are rural, 50% are urban, destination type short-term rentals. And they combine their technology background with a very strong design element with some of the craziest amenities you've ever seen in a short-term rental, like bunk beds with slides and like every sporting activity you can possibly squeeze into an acre lot, basketball, pickleball, horseshoes, like actually they have like mini golf courses. They had one that has it's got like a racetrack for little kids' cars. They just go over the top with the design element. And ultimately what they're doing is they're competing against the mom and pops out there that just simply don't have the resources to make these type of finishes in these short-term rentals, which gives them the ability to increase the average daily rate. Their occupancies are significantly higher than the market will generally allow. And it just creates an overall experience for not only those folks that stay in the homes, but for the investors who also get discounted rates to stay in the homes. Um, just a great experience. So it's very similar to a lot of the models you see. This offering will have a slightly over 2.1 or 2.2 equity multiple over the same 4 to 6 year time period. But this one is more of a cash flow play as it kicks off almost 9% cash on cash by year two.
wow.
So it's a cash flow opportunity for the passive investor and still have kind of ownership rights on those assets as well.
Man, that's amazing. So the short-term rental game, I've always purposely stayed out of it because it's so much work.
Oh,
We
it
have a
is. Yeah.
camper. Yeah, we have a camper that sometimes we rent out and it's a lot of work. But when you hit the scale that they're at, well, they've been at it for a while.
Yeah.
They didn't just get there, but probably about 3 or 4 units is scale where you can hire like a full-time assistant or something. Those are cash cows,
Yeah.
absolute cash cows, and they're at 120 or so. So they've been at
Yeah.
scale for years. The like I said, or like I just said, what caused me personally to not want to do it is running it myself. I hate
Yeah.
that. But when you're at that level, Randy, I mean, it's just like 9% year two cash on cash, which is unreal. I mean, that is a massive return.
Yeah.
So TechVestor, not a household name, but it should be. They're massive too, just like Lone Star Capital.
Yeah.
I mean, you're working with huge names in this industry. If you're in real estate, you've heard of both of these companies that you're working with. So
Yeah.
kudos.
I've been very fortunate. And I also work with a group called Rise 48 here in Phoenix, which is
And
everybody
in
knows
Dallas
Zach and the
too
team,
now.
and in Dallas as well.
Yep.
And I'll be launching a new partnership with a group called DLP, which has a debt fund that I'll be making available to my investors in January, which will pay probably 8.5 to 10% monthly distributions with
And
90-day liquidity. So there's a lot of options out there for the new or newer passive investor that's just getting started in the space for sure.
man, that's awesome. Those are and for the audience, these are numbers that are phenomenal, right? The 5.7% for the value add deal is sometimes year three,
Mhm.
sometimes year four. Sometimes it never gets that high. And so for you guys or you and Lone Star Capital to hit those numbers year one is massive. And then the short-term fund that you have or that you're working with TechVestor, that is just a cash machine. I mean, it's just
Yeah.
prints it out. And the best part about you, Randy, is you're not the one managing talking to the tenants or the renters. But then on top of that, you're doing the due diligence with TechVestor and with Rise 48 and Lone Star Capital and some of these top operators, massive operators, by the way. And you have that relationship where they will pick up a call anytime, and because of the check size that you bring, so you're able to get some extra perks and probably a lot more information than someone who would just invest directly into it by themselves. So um, I love that, man. How did you partner with these guys? I know you mentioned something earlier that you kind of raised $1 million because you just loved the syndication space because it had an impact on you, and you
Yeah.
know you were working full time. But did you raise $1 million for one of those teams, or how'd you
Yeah,
do?
so I mean, ultimately what it was is I was talking about this at work or with people in my peer group, and people got excited about it. So I just simply introduced them to the operators.
Yeah,
And being a sales guy, of course, I'm constantly asking the folks that I'm referring the dollars to, like, hey, I'd love to make a couple of bucks if I refer them over to you, but you can't actually earn dollars for referring people to investor or to operators. So um, the SEC frowns on that very, very heavily. So it just wasn't an option. And one of the operators had mentioned to me this fund to fund model while I was still employed, but it seemed like it was confusing. It would take too much time, and I just didn't have the bandwidth to do it. So when I ended up getting laid off, it just made sense to go one step further and formalize that
yeah,
process, because I was already talking about it and referring it to folks. And um, I'm a guy, as I mentioned, as a sales guy, like I shout it from the mountaintop if I'm excited about it. So
yeah.
it just worked.
An evangelist for these operators and for multifamily and short term and just real estate in general, which I love that because it's so tr it makes it where you're not lying about it. You
Absolutely.
got just like me, and one of the reasons I started the podcast is I was just so impacted by being able to passively invest
Hmm.
that I started telling so many different people about it. And
Yep.
I love talking to investors, and they're like, oh, I just sent my wire over, and it's their first deal
Yeah.
and they're nervous, but they're like, oh, I can't believe I did that. But then they're so excited, and we get to help people. You mentioned you helped, I think it was over 90 people or 100 people do
Yep.
this. I mean, that's a lot of life-changing text and emails and phone calls.
Absolutely.
And, I'm sure they're all like, oh, I wish I knew about this sooner. So
Well,
that's,
and when the light comes on and you start figuring, like, there are operators that'll take $25,000 investments. And if an individual could put 25 grand per year into an investment like this, and if they're doubling every 3 to 5 years, within 3 to 5 years, you've created 25 grand a year in essentially tax-free income.
yeah,
And I'm not a CPA, so certainly talk to your CPA about tax advice. But if you scale that and you do 50 grand a year or 100 grand a year, essentially you just got to decide, like, what's the amount of money that I need to make on an annual basis tax free, and invest that amount for 3 to 5 years, and you're there. And as that starts to mushroom and grow larger and larger and larger, um, it can have a significant impact for as little as 25 grand. Like,
yeah,
that can have a huge impact on somebody's life. So I personally I think everybody should have at least a portion of their investable capital in this space. Even if you're not 100% all in yet, 25 grand will convince you. I guarantee you, when that first deal goes full cycle and you start getting K1s with passive losses, like, it's a game changer,
yeah.
absolute game changer.
So a K1, by the way, is just like a W2, or what is it, a W9?
9. Yep.
Yeah, W9 you get from your company at the end of the year. Each real estate deal sends out a K1. So it's the same thing, except the income is usually a lot lower because the depreciation. Again,
Exactly.
neither one of us are CPAs, but we can introduce you to some, I'm sure.
Yep.
Yeah, man, I love that. I love that you just were so impacted that you shouted it from the rooftops, that You're helping people achieve that time and financial freedom. And, Randy, something that you had mentioned, and I kind of touched on it several minutes ago, but you only started doing this in 2018 and you only started doing syndications in 2020. I mean, that's 3 years and you've already helped so many people in just 3 short years. But you said in 2017, 2018, we gotta stop relying on the W-2 income. So if it worked for you, it can work for anyone, right? I mean, you're not to call you out, but just like me, you're not this, multi-billionaire, right?
Yeah.
Just normal
Yeah.
people. You're in tech sales and I was in tech sales and it's helped both of us immensely in only a few short years. It's
Yeah.
easy.
Absolutely. Yep.
Yeah. Um, so why do you think real estate is so attractive?
So like the Instagrammable response to that is there's all kinds of different ways to make money in real estate, but over any amount of time, real estate always goes up in value. You're going to have ups and downs, definitely. There are going to be crashes just like anything else, but if you hold an asset long enough and you're not forced to sell during the downturns, then values are going to go up and you're going to do very well with that. Since you mentioned it earlier, you're kind of in partnership with the government as well. Though, so the tax benefits that come along with owning real estate are significant. And as folks start to accumulate more and more wealth and have higher income, your tax strategy becomes almost as important as your income strategy.
Yep.
And I would argue even more so as you become more and more vested in real estate. So, I think that the thing that I liked most about it is it was something that I could get my head around. I understood it. I felt all those years investing in my 401k and putting money in the stock market, it was just kind of going off into the abyss. And to a certain extent, like you can't even touch that money anyways until you retire. So it truly was like this money was coming out of my check and it was going over to the space that I wouldn't be able to touch for 20 or 30 years. Like with real estate, I'm able to invest in something that I can drive by on a weekly basis if I want to. I can walk in and talk to the property manager or the person who's behind the desk to find out what's going on. I can pick up the phone and get like detailed information about everything that's going on with this asset. And you just don't have access to that when you're doing it in the stock market. So it's tangible. There's tax benefits. You get appreciation. You get monthly cash flow. It checks all the boxes, in my opinion.
Yeah, I I agree. I'm right there
Yeah.
with you.
Speaking to the choir here, I
Yeah,
know.
yeah.
Yeah.
No, I love it though. I mean, it's if you invest in a company, the only way to get a hold of them is say you want to buy something, right? And then they'll call you and say, yeah, let me sell that to you. But if you want to know about their long-term strategy, they don't know, and the people that know won't tell you. But here you go to Lone Star Capital, Rise 48, TechVestor. Hey, tell me what's going on, and they'll give you more information than maybe you care about, right?
Yeah, no,
Um,
definitely.
which is a good thing. But yeah, no, I love all those things that you mentioned because it definitely checks all the boxes for me as well. There's just so much control. Like you, Randy, the 401k IRA. I mean, that's the only thing I knew. That was my path, right? I was told to work till I was 70. I was told to invest so I could have a modest nest egg in 600 years. But
Yep.
the reality is it's I don't want a nest egg and when I retire. I want to be able to use it now while my health is a lot better.
Yeah.
And being able to invest with people like you who invest with the top of the top in the real estate game is amazing. Um, Randy, I know we have a few minutes left. I want to ask you about a recent book that you've read or listened to that really stands out to you.
Um, yeah, interesting. You were just sharing that point about you want to be able to use your dollars while you're healthy and versus saving for retirement. And it made me think of a book that I did read this year called Die with Zero. I don't recall the name of the author, but it was a book that I was introduced to through an organization, a mastermind that I'm a part of, GoBundance. And the premise is very similar to what you said. Like we have these ideas where we want to save our money until so we can create a legacy to hand down to our kids and provide security for our families and those types of things. But I think the general premise is if you're planning on wanting to give this money to charity when you're young or when you're older, give it to charity now. If you're planning on wanting to give your kids security, give your kids security now versus waiting till later. And if you had the ability of knowing the day that you're going to die, you could spin it down to zero perfectly. Nobody, of course, knows how to do that, but the value that you can bring to your friends, your family, your society, the things you care about, all of those groups would do better getting those funds today than they would when you die. And it's a hard concept for me to get my head around, but it's true.
Yeah.
Like when I think about my daughter, would it make more sense for me to give my daughter $500,000 when I die or help her buy her first home? Like I think buying her first home is more impactful than giving her a chunk of money, which she probably doesn't even need it
Yeah.
as she,
Right.
hopefully she'll be in her 40s or 50s by the time I die. So anyways, just a
Yeah.
neat book, different perspective, challenged my way of thinking a
Is
lot.
that Bill Perkins?
I believe it is. Yeah.
Okay. Die
Yeah.
with zero, getting all you can from your money in your life, I think is the tagline.
That's
So
it. That's
awesome.
it. Yeah.
I
Great
didn't
book.
know that. I had to look it up, but I've heard of that book before, and um, I need to buy that one. I love that philosophy or that mindset because that's, in your example, Randy, of 500K when she's 50 or a home or heck, putting 50,000 into your fund, right? And
Exactly.
and
Yeah.
teaching her how to do that. Anyway, um, thank you for that recommendation.
Sure.
Um, what can people expect to see from you and your business in the next few years?
Yeah, I think the goal when we launched, or when I launched Impact Equity 18 months ago, it was to be able to provide diversification across asset class, operators, geographies, business plans. And that is still the goal. Like I want to create a one-stop shop for the newer passive investor to give them access to multiple deals that have been vetted professionally and at a level that they could not do on their own. So in coming years, I think you'll see additional asset classes. You're going to see additional operators with the goal of putting, 2 to 3 deals per month in front of our investors. So it's not as grandiose as, raising $1 billion or anything crazy. Like I don't need to make that kind of money. I just really want to share this idea, this strategy, this process to as many people as possible. And I set the goal of helping 1,000 people place their first or next investment when we launched it, and we're already close to 100. So I might
That's
have to grow
awesome.
that number from 1,000 to 10,000. Who knows? But that's the goal today.
Good. I love that. Man, okay, so we've talked about a lot, Randy. But those two funds that we talked about that you have going on right now that are 506C, the short-term rental fund with TechVestor, and then that 335 unit in San Antonio, which sounds like an amazing deal that you have with Lone Star Capital. How can people reach you?
Yeah, so the easiest way is to go to the website, impactequity.net. There is a book a call with Randy Calendly link on there. So I encourage you to schedule some time. If you just want to DM back and forth, I spend a lot of time on LinkedIn. I'd encourage your folks to follow or connect requests with me there. And of course, I'm on Instagram as well, Randy Smith Investor, but LinkedIn or schedule a call. And one thing I'll share too is that I think people at times don't schedule calls because they think there's going to be some type of high pressure sales or something like that. Like my wife and I talk about this all the time. Like my calendar is open to anybody and everybody. If anything, it's too open where like I just love talking about this stuff. And if I can
Yeah,
help people down their journey, like people don't have to invest with me. I just think it's really important that they get some dollars into this space and find a good operator to partner up with to put some capital in. I'm convinced once you get in your first deal, you're just like you and I, you're going to wish you had started earlier and more often and you'll be further down that path to decreasing your dependence on your W-2 before you know
Yeah.
it.
So you said no high pitch sales call. That's what every sales rep says, right? Just joking. No,
It's
no.
possible. Yeah, it's
You know
possible.
what's true though, Randy, is I've not met a person in real estate. That's not entirely true, but I'd say 95% of people in real estate that do what we do love talking about it. And
Yep.
so if you're like, man, Randy sounds great, but I'm nervous or I don't want to talk to him, reach out to him. He wants you to. He loves talking about it. I can facilitate an intro or whatever, but man, I love talking about this. You love talking about it. That's why you have what's your podcast called? We haven't even talked about that.
Yeah, that's right. So I forget to mention this all the time, but it's called The Gentle Art of Crushing It. And I am one of 4 co-hosts, and I host the Thursday edition, which is 100% talking about passive investing and educating and inspiring the newer passive investor. So
Awesome. Super
yeah,
cool. So maybe you want to listen to Gentle Art of Crushing It, which is all about passive investing. And then you could reach out to Randy if you'd like, but definitely reach out to him. He'd love to talk to you. Impactequity.net. You said your calendar is on the website, mine is too. That means he wants to talk to you. If you're listening, yes, I'm talking to you. And then also on LinkedIn and Instagram. So I'll make sure all of those are in the show notes, even your calendar, if you're fine with that.
awesome.
And then that way people
Absolutely.
can reach out to you. Man,
Awesome.
Randy, thank you so much for being here. I love the fund to fund model. I think it's awesome that people can do fund to fund, but it's hard to partner with some of the top operators, and you've done it very quickly, and they obviously have some great deals already, which is especially in this time when we're recording this, those numbers that you said are pretty awesome. So,
Yeah. Yeah.
but yeah, thank you so much for being on the show, man. Really, really appreciate talking to you.
Thank you as well, Charlie. It's been a lot of fun.
Awesome. Thank you for listening to today's show, brought to you by H&K Investment Group, your home for passive investing. If you want to learn more about how you can invest with us, please check out our website at hkigllc.com. Don't forget to like this episode and subscribe to our podcast. Please leave us a review to let us know how we are doing. Feel free to connect with me directly on LinkedIn or Facebook. As always, I'm your host, Charlie Hardage. Catch you next time.